Hello, my name is Thomas Key, and I am President and CEO of Stock Traders Daily. Recent market action has caused some anxieties to increase and some concerns to increase, and I thought it would be better for me to add value in this particular case by offering a video explanation of what I'm seeing. Of course, my normal analysis is going to be provided. Our charts and text and newsletter on the website will be the same, but in an effort to add value, a picture speaks 1,000 words, if you will. I thought this video would be better and easier for you in terms of understanding what it is that I'm looking at right now. In addition to that, this video is something that you could share with your friends and family, but please don't spread this out over the internet. Our clients obviously pay for this information, and I don't want it spread out everywhere, but if you want to share it with somebody that's close to you that you think might benefit from seeing this, please, by all means, share it with them. With that, I'm really looking at price, as you know, as a driving indicator of what the market's really going to do or what it's telling us, because I think that the market knows best. At least the market knows best because we depend on the market to make money. So we better think that the market knows best and react to the market when the market does certain things, because that will help us make money. But what is the market telling us here in this environment? That's really the goal. Right. So with that said, let's look at the market, what the market has done recently. The NASDAQ 100 has fallen by about 3.5%, the S&P 500 by about 2.7%, the Dow Jones Industrial Average by about 2.3%, and the Russell 2000 by much more, 6.9%. Now, this has all happened from all-time highs. We need to take that into account. And the NASDAQ 100 even fell from a big round number, a psychological number, if you will, at 6,000. This stuff needs to be taken into account, of course, but we really want to know what happens now. And I will look at price to help us make that determination, but you'll also hear some things from me that you don't necessarily hear regularly in my newsletter, because again, I focus more on price than I do on the noise. But Trump matters here, right? He does, and price is telling us something about Trump, I think, and you'll see what I mean. Stimulus matters. What's going to happen next week in Jackson Hole? Hey, that matters too. That's a central bank meeting, right, in Jackson Hole. That matters. And so does valuation. So we're going to look at all of these things in this short presentation. And we're going to start with the technicals. So this is a longer term chart of the S&P 500. And recently we tightened up our channel. We tightened up our channel to represent this red channel that exists right here, because this market has been oscillating in this small, tight channel for the better part, for the entire year, and since December of last year, on the heels, if you will, of the November election. And arguably, the market has been in this tight channel in the upper end of the wider range as a result of optimism about what Donald Trump could possibly do. Pro-business, reduced taxes, these are favorable as far as the stock market is concerned. And so it was in this upper range, the market trading within this upper range without falling back to this lower upward sloping support line. Now, that's important to recognize, especially when we factor in that the lower support line represents a trend line that tracks actually that November low. Now, we're going to incorporate this as I broaden out this observation, but before I do that, look up here. Price is telling us something about this trend, and I think because this trend largely had to do with a belief that pro-business and lower taxes would be something that Trump would actually be able to accomplish in some way, shape, or form, his policies would get there. This is the market questioning that as the upward sloping trend that had been so solid begins to break. The market is definitely questioning what Trump is trying to do, or at least his ability to get it done. And we can see that in price quite clearly. Now, when we expand this chart out a little bit, we start to see some other very interesting things. Specifically here, we're seeing an uptrend that actually stems back to the beginning of 2016. The uptrend that we are in right now is actually one that began in 2016, but it got much tighter right here when that Trump bid came into the market, if you will. The market has not fallen back down to these blue support levels since then. But because this Trump bid trend line is starting to break the support line that existed from the December lows, starts to break, this other support level comes into play. And that other support level exists at about 23.55. So this break of this bullish trend line that largely represented confidence in Trump could very well lead to a decline to about 23.55 in the S&P 500. And that decline to 23.55 could largely wipe out most of the gains that we've seen for so far this year. Very possible. It can happen. We can go back down to levels that the market was at, call it in February. Very, very possible, based on what we're seeing. But even with that, this market would still be in a longer-term uptrend, at least since the beginning of 2016. And why is that? What does that represent? Well, that blue line represents a broader bullish trend, if you will. And that broader bullish trend is something that is defined by stimulus. The ECB started to buy corporate debt on the heels of Brexit. And that happened to be early in the middle of 2016. However, they announced they were going to do that early in 2016. So they made a transition in the early part of 2016 that shifted their stimulus program in a way that started to directly influence asset prices. And the stock market has moved straight up without volatility since then. Let's look at this chart again and I'll show you what I mean again. The market has moved up without much volatility since then. Since they announced they were going to engage in this corporate bond buying phase of their stimulus program. Now, if you have any questions on the relationship between what they're doing and the influence on asset prices, think about it like this. You're a hedge fund and you own $50 million of traveler's debt, right? And the ECB comes in and they buy it from you, and it's paying you a measly, let's call it 3.5% or something not so good, right? And the ECB comes in and buys it from you. And then you're left with this money and you're asking yourself, should I go out and buy some more similar debt? Or would it be better for me to actually invest in the stock? Because the equity is paying close to that in interest and it has capital appreciation potential. Now, it's not dollar for dollar, of course, but some of the money is finding its way into equities directly as a result of this effort. And that creates a bid to the stock market. And institutional investors, when they see billions of dollars, by the way, ECB is doing this with about $15 billion, but they're at about $60 billion overall for their stimulus on a monthly basis. So about $15 billion is finding its way somehow into the equity market, with some of that directly going into the equity market. And when institutional investors see this constant bid that doesn't go away, it's tough for them to warrant fighting that, right? And so they just kind of stick with the game plan and ride the wave, if you will. That's the notion of what goes on when you have this constant flow of stimulus. However, this constant flow of stimulus has also done something else that's very, very important. And that is that it has increased the PE ratio considerably on the S&P 500 and Dow Jones Industrial Average. One of the best ways to look at this is to look at the Shiller observation of PE, which is pretty close to the Wall Street Journal's observation, putting it somewhere at 24, 25 times earnings. But what's more important than that is that it's also putting it at a level that's higher than at any other non-recessionary level in history. The PE ratio skyrocketed in 2009 and again when the internet bubble burst, right? We saw PE ratios shoot through the roof. But those were recessions and market crashes. The PE multiple on the S&P 500 historically is somewhere near 14.5. That's the average PE multiple is somewhere in the middle here. And our PE ratio is much higher than that. But it's also much higher than that in a bull market environment. This isn't a recession, right? We're in a bull market environment here, and the PE ratios since 1880 have never been higher than this in a bull market environment. We are in a very expensive market environment. And in my opinion, we're in this environment because the ECB is dumping money into the system. But they're not really slated to do anything about that right now, at least not today. Last week we saw a print of negative 0.6 as far as the ECB CPI, the Eurozone CPI is concerned, and I think their inflation rate's running 1.2%. They're looking for 2%. It doesn't sound like the data is there for them to warrant stopping their program based on what they've said before. But remember, the IMF has warned about this. The IMF has said that stimulating asset prices like this really doesn't do anything to spur economic growth. But what does it do? Look, it makes markets go quite a bit higher. And in fact, if we take this out even further, we can see something very interesting. This is pretty much when stimulus started by the FOMC. And the market has gone straight up, except for one interesting time frame, which was about 2015. Look at 2015 a little closer. So the ECB announced their stimulus program right before the FOMC stopped their stimulus program. And this was as 2014 came to an end, right? But the ECB didn't start it until well into 2015. However, the ECB didn't initially adopt a stimulus program that was like the one the FOMC was ending. You see, the FOMC started their stimulus programs back in 2009, 2010 with the objective of saving the banking system. And then in 2012, when they started the second round of stimulus, it was earmarked directly at asset prices. Well, the ECB started their stimulus program to protect European banks, just like the FOMC did initially too. And then they earmarked asset prices directly when they transitioned to start buying corporate debt. In between there, when there was no money being targeted to those asset prices, there was significant amounts of volatility in the stock market. That's because there wasn't this constant bid in the market coming from fabricated demand. The market saw 14% declines from time to time as that happened. So volatility is absolutely likely if stimulus comes to an end. But again, there's no end in sight right now for stimulus. So given where we stand right now, the probabilities of seeing simply an oscillation down to this trend line that represents that positive bias as that relates to this stimulus effort that started when the ECB initiated a corporate bond buying program is likely. Seeing a decline to near 2355 in the S&P 500 is likely. However, we do have a central bank meeting happening Wednesday and Thursday of next week. No one's expecting any surprises out of this. But at this central bank meeting, very historic events have happened in the past. The IMF is already telling the ECB, and all central banks for that matter, that stimulus policies doesn't produce economic growth. They already know that. The ECB has already tapered once. Whether they do it again, I don't know when they'll do it again, but I'm pretty sure they will do it again. And there's a risk that we may hear some more about this at the Jackson Hole meeting. So we have to keep that in the back of our head. And if that happens, this line would even be in jeopardy. And probabilities might even suggest, if the market reverted back to its 14.5 multiple, that all of these gains that we've seen since stimulus started would be wiped out based on simple multiple contraction down to a 14.5 average PE multiple, average historic PE multiple. So there are some things to think about here, right? But the most important takeaway as far as immediate observations are concerned is that the Trump trend, we'll call it, the Trump trend that began back in December is breaking. The market is telling us that it doesn't trust that Trump trend anymore. And with that, given current conditions, downside targets to the trend that represented the stimulus efforts by the ECB when they started their post-Brexit bond buying program directed at corporate debt would be likely. So a decline to 2355 in the S&P 500 from 2425, it's reasonable. About a 3% pullback from that break of trend, from that break of the Trump trend. But should the ECB say anything about the bond buying program that they're currently engaged in, if they stop any of that, a reversion down is very, very likely. 2015 proves volatility will come if they don't continue to buy debt. But if they don't continue to buy debt and there's nothing lingering suggesting that some other form of stimulus is going to come, that volatility that we saw in 2015 is likely to get much more severe. That part of this, I don't know about. But from a technical standpoint, based on what I'm seeing right now, a reversion back down to 2355 or so is very possible given the break of the Trump trend that we're seeing. That second part of it, the bigger risk picture, more information needs to come before we'll know more about that, right? But we can clearly identify what the cause for this asset price appreciation that we've seen since 2012 was. That is stimulus. So until that comes to an end, the up channel, at least the blue up channel, is likely to be consistent, right? The Trump channel is breaking. So what we're seeing now is the Trump channel breaking, and that would lead us down to the, we'll call it the ECB bond buying program channel, the ECB channel, that blue trend line. It would take more than what we have already for that blue trend line to break. So think about this closely, monitor ECB consistently, and recognize that the market is telling us based on price that it's discounting the Trump trend and likely to fall a little bit more given this observation.